So we'll call it up to order the October 29th Montgomery County Employees Retirement Board meeting. Note the presence of all members of Retirement Board. I'm going to ask Dennis DeSanto to lead us in the pledge.
Pledge allegiance to the flag of the United States of America and to the republic which stands one nation under God, indivisible, with liberty and justice for all.
Okay. Alan, we don't have any public comment, do we? Okay. All right, no public comment. Moving on to the approval of the minutes. I'd like to make a motion to approve the minutes from the last retirement board meeting on July 16th. Is there a second?
Second.
Seconded by Controller Hart. Then I'll turn it over to our CFO.
Thank you. Just a few comments before we get started with the presentation from SCI. We're on schedule to complete our contribution, the county's contribution to the pension plan. It's going to be a total of $32.5 million by the end of the year. That'll be 100% of the contribution that's required for 2025, and this will be our 5th year to contribute 100% to the plan.
Congratulations on that.
Also, I just wanted to note real quick, I sent out a report via email, and those that are in the room have a hard copy. It's put out by the Marquette group, and basically it's really good information. It's a comparison of county pension plans here in Pennsylvania. So it gives you some really good statistical information. This was updated as of 2024. And they do this every year, so we'll continue to get this. But if you have any questions after you read through the information, just reach out. With that, I'm going to.
You guys need books? You have it. Oh, yeah. Oh, thank you. Sure. How are you?
I'm doing great. How are you guys today? Good to see you. Hello to those online. So if you could start the presentation kindly on the executive summary. One more page, please. Great. Well, good afternoon. I'm happy to report good news today. Seems like the markets, nothing can shrug off a really strong market. We're hitting new records today. You can see on the executive summary here, we started the year at 652 million, and we ended the quarter at 734 million. And as of yesterday, the plan is up to 748 million. So it's really been a fantastic year for the portfolio. The third quarter, the portfolio earned a 5.43%. And year to date, your performance is 13.54. And it's interesting, we talked about your goals with COLA and what's needed for the plan, the volatile year that we entered into with Liberation Day. It's quite remarkable to see that return of 13.5% and even higher, kind of given that the market is still rallying. Last year, you had 11.7%. So you beat the returns of last year. And then 2023 was 15%. So as we continue to get rid of that 2022 year, that was the strong negative year, this will certainly help in a number of measurements that you're looking forward to. You can see that the portfolio earned 87.8 million year to date through September 30th. And just to put things in perspective, I always like to give a high level summary of the asset classes. You can see equities here. Big responsibility as far as the earnings that you did for 13.5%. Equities were up over 19%. And really we started strong gains despite, you think of all the headwinds with tariffs, with geopolitical issues, with the government shutdown. What we're seeing is strong corporate earnings. We saw a Federal Reserve who start cutting rates in September, and that really helped lead to this rally. A big part of the equity rally, however, was primarily focused on artificial intelligence. We've been talking about that just about every quarter. When I meet with you, we see the Magnificent Seven book. I have a few slides in here if you're interested in just really expanding artificial intelligence and really the strength of that's taking place and really leading, especially US equities. We did even see AI have positive results in China in their artificial intelligence areas and those tech areas. And then for a nice surprise for the quarter was small cap. Small cap had been lagging, but since the Federal Reserve cut rates, that helps a lot of the smaller companies who are refinancing. So we saw small caps have a strong quarter of up 12%. But when we do look deep beneath the surface, it was really a lot of the riskier names that did rally, almost the junk rally, low quality. But your portfolio absolutely benefiting over 19%. Looking at fixed income, positive markets, bond markets were volatile, interest rates were volatile, but we did see yields fall. We had a steepening of the yield curve. The shorter end of the curve steepened, and that again is due to the Fed Reserve cutting. And then the longer end of the curve was really due to concerns about inflation and the debt. So we continued to see that steepening of the curve. The good news is all three fixed income funds that the portfolio has in their assets did very, very well. And I'll show you that when we look at the performance. And then finally, your alternatives up over 8%, 8.7%. They continue to provide returns in all markets, your special sits and your structured credit funds. As far as the portfolio governance, we updated your allocation last year. We did do a review in the spring. If you recall, there was a slight recommendation to diversify your US equity a little bit due to some of these high concentration names, and we did recommend to shift duration a little bit in fixed income. Nothing was agreed upon at that meeting, so I'm still open to having more education, more dialogue, and happy to discuss that. Any questions on the executive summary? Can you move forward, please, on the markets? Do you mind moving to the market page? Great. Oh, thank you. Sorry. I'm looking at you and you're already there. So this, you're familiar with this slide. This is the market performance overview. It gives a nice reference when we look at the returns of your portfolio. The blue bar is the quarter returns, the gray is year to date, and then the darker black or darker gray is your 1 year. But quite, it's quite revealing when you look across all asset classes, positive on a quarter, 1 year, and year to date, except for your long duration, which you don't have exposure to. So really strong markets. A couple things to point out, which I mentioned in my executive summary. We saw large cap did well this quarter, but you saw small cap, again, up 12%, leading the charge when you look at US equity. But what I think is noteworthy, when you look at world equity, ex-US and emerging markets, if your eye can focus on the light gray bar, you'll see it's been really, wonderful returns on a 1 year base, or excuse me, on a year to date basis. Emerging markets is up almost 28%, and world equity is up over 25%. And again, when we met last time, we discussed that US equity markets have been leading equity markets internationally and emerging for the last decade. So we're really seeing a shift. You have exposure. That's why it's really important to have diversification within your portfolio. We talked about, the dollar had declined, which really helped provide some of those gains when you equate them back into the US dollar. You can see the return just about double what US equity. Again, so we continue to reinforce diversification. That's another benefit for the portfolio. And then you continue to look down, you can see fixed income across the board did well. The high yield bonds and emerging market debt, again, looking at the year to date returns, you can see they're making nice contributions. Emerging market almost 15%. And there are areas of fixed income that's nice to see that are also contributing to your return. And then finally, commodities, you do have exposure to some commodities. They had a nice return as well. So looking at the next slide is just the fixed income review. I just touched on a few of these comments, but you can see the yield curve. And again, if you look at the blue, it's a little bit hard to read, but on the yield curve on the left-hand side, you can see the bright blue dipped down a little bit on the shorter end of the curve, again, with the Federal Reserve cutting. And you can see that the steepening continues as the 10-year and further out on the yield curve continues to remain high. And again, concerns about inflation and concerns about our debt keep that number high. And that feeds into, mortgage rates and interest rates that consumers are feeling the pinch, and that is still of a concern. But the good news is on the right-hand side, you can see that due to increased risk appetite, you can see investment grade, high yield, and emerging market debt, their option adjusted spreads continue to go down, and they're at historical tights. So it's kind of an incredible market where you have equity, at all-time highs, you have spreads at all times lows. So it's really a beneficial marketplace, but concerning to some about maybe an AI bubble. So if we look at the next slide, you can see, I just have a few slides in here. And if you have a minute, if you guys are tight on time, I can skip them. Do you want me to skip them? Skip them.
We're a little tight on time.
Okay, let's move forward then. If you have interest, you know, if you want to look back, it really just speaks to the concentration risk within the S&P and how artificial intelligence is leading. It's funny because NVIDIA announced today they're $5 trillion market cap, and they're up 55%. So it's just a very interesting perspective. So I'll just go to the final slide so we can wrap it up. So everyone can move on to their day. There you go. So just looking ahead. Oh, back. One more with the blue page. One more. There you go. Thank you. I know I talk fast as I've given up. Just looking ahead, you know, these are some of our thoughts and what we're looking out for as we oversee your portfolio. Economy continues to have a good, you know, steam ahead of it. We've seen strong corporate earnings. Consumers are spending. We're starting to see some cracks in lower income, but the wealth effect, those who have the assets continue to grow in their portfolios. So I think that's surprising a lot. And the AI investments that are being made are really strengthening the markets. We do see increased fiscal spending, and today the Fed is meeting in about probably a half an hour, and the expectation is they will cut interest rates 25 basis points. So the markets continue to like that, and that's, you know, appreciated within the markets, and that provides growth. What we're looking out for is the Supreme Court is meeting, I believe, on November 5th. So they're going to weigh on the legality of some of the tariffs. So we might see some market disruption depending on what the outcome is there. We still feel inflation is the last leg is still going to be persistently high. We saw it come in at 3%, which is a little bit lower than what's expected, but still a driver, still a concern. And then finally, accelerated productivity is really going to be key. You look at all the investment in artificial intelligence, all the market concentration and the rally, it's really starting to see the productivity is really what we're going to be looking for. And I think it was so interesting, you know, with Amazon, you know, announcing they're laying off 14,000 to 30,000 jobs. A lot of that is due to artificial intelligence. So we started to see some of these big firms. You know, those of us who have college kids, we know that that's hurting them, but it'll be very interesting to see the productivity because a lot of the earnings today are based upon future outlook and future investments. And then finally, bond yields we think will remain elevated. So I will end it there so we can look at the portfolio. If you don't mind flipping through probably about 4 slides. Any questions on the outlook or the markets?
Well, Kathy, I have one quick question. Could you hear me?
I can, yeah.
So the two things that you said that are kind of interesting. One is that the AI, so there's some are predicting it's a bubble, or is it going to, or is there a prediction of leveling off, or like what's the thought on that when you said about some are concerned that it might be an AI bubble?
Well, there's a lot of things that factor into that, Tom. There's, you know, some cyclicality, like you see all these deals being made between NVIDIA and Oracle and OpenAI. And a lot of the concerns, it's very cyclical. So, and there's a slide in there, NVIDIA is made a deal with OpenAI, then OpenAI turns around and buys NVIDIA's chips. So there's a lot of, you know, vendor financing, they're calling it. So the money keeps exchanging hands. There's another deal with Oracle and OpenAI that are, I think it was a $300 billion deal. And that's not going to occur until 2025 with, you know, improvements 5 to 10 years out. But that all being said, Oracle stock went up 30% when that announcement came out. So it's you know, there between the revenue and what's happening within these companies and the finances and a lot of it being projected on in the future. The concern really boils down, Tom, is that the valuations are so high. So that they're just priced for perfection, and a lot of that's baked into the market today. The bigger concern is that there's another side in there. we looked at AI companies in the S&P 500, and since ChatGPT was rolled out 2 years ago, they represent over 43% of the S&P 500. So if you really look at these remarkable gains that the US large cap equity market is producing, you see it's very isolated and concentrated. So if you were to take out those names, you definitely would not see these high returns. So to sum it up, if we have these returns all baked in today and we don't see acceleration of productivity, you could see that level off, because there's, it's kind of priced for this perfect world that AI is going to, solve the world. Does
And
it make sense?
yeah, kind of. But the other thing is that it's such a small, there's not many players in the marketplace either. So that kind of makes it, I'll say real players in the marketplace, right?
That's right. No, that's
So
right. There's just a few names that we hear about
right.
every day.
So it's so
Mhm.
the trading going between them, or the agreements going around between them, kind of makes it interesting.
Yeah.
And I agree with you as far as like it's like you scratch my back, I'll scratch your back
That's right.
relationships
That's right.
almost.
That's right.
So there is some concern over what will happen. But on the flip side, you got major players that are in that marketplace. So um I don't know. It's hard to say what's going to happen. And then you mentioned that the inflation's is predicted. Uh, you said what, coming in at 3%?
That's what it came in, I believe, last week, even though the numbers are hard to measure with the
Right,
government closure. But it
right,
came in 3, markets were expecting 3.1. Obviously the Fed's preferred number is 2%. There's lots of question on that, if that even makes sense to have that number, should it be higher? So, that's the concern, but I think the markets rallied because the expectation was it was going to increase 3.1% and it came in at 3%. So
yeah,
that gives the Fed a little bit more wiggle room, and the markets rallied. So if you think about the Federal Reserve is looking at softening employment and softening labor. So they want to get ahead of that and cut rates, but their concern is if inflation's too high and remains too sticky, or if tariffs produce additional inflation, they don't want to be cutting rates in that environment. So by showing an inflation rate that was a little bit lower than is expected, it allows the Federal Reserve to cut to cut interest rates today. But it is a balancing act. There's risk on both sides of the coin with what they're facing, especially with lack of data. If we stay closed, if the government stays closed for another week, we're not going to have October inflation reports. So it just makes operating in that environment even more challenging.
right.
Does that answer your question?
Yeah, but I'm not sure. I'm not sure if I agree with the statement that inflation's high. Um, it's trending. It's not trending. I mean, high to me is, when 8-9% high.
That's right.
Two
It's
three
definitely,
percent. That's now we're stretching when we start to say 2-3% is high. But I think that it again, depending on a decision the Fed makes today, will really depend on what the last quarter looks like.
yeah, and I should have clarified high relative to the Fed's goal of a 2% inflation.
Right,
You're right. It was at
right,
9% last year. It's absolutely come down. It's done extremely well given, concerns of tariffs, and they don't seem to be impacting the inflation rate as strongly as many had thought.
right. So, all right, well, yeah, I mean, I'm tracking, some of the stuff that you've been talking about, and I kind of agree. I'm just really interested. The AI thing, I thought it was kind of interesting when you said about a bubble. So, but I agree with the assessment of what you're saying. I just, I kind of think that's an interesting way to say, that there's concern of, is it a bubble, which one could argue it could be. So we'll have to watch that. So, but anyway,
Yeah.
thank you.
Absolutely. Yeah. Great questions. We're going to be looking at productivity. That's the key measurement when you look at it.
Right.
So thanks for the great questions. I appreciate it.
Thank you.
Go one more slide further, please. And this just shows the reconciliation of the assets. You can see I've highlighted here the 87 million in your year-to-date gains. And on the next slide is the portfolio returns. I'll just focus on year-to-date. You can see great returns of 13.5 on a net basis. One thing I don't talk about a lot, but your index is 12.8%. So you can see there's 70 basis points return above your benchmark. Both of your equity funds are passive, which means they replicate an index. But your fixed income and alternatives do track a market indice, and they have active positioning, which means they stray from the benchmark to provide additional returns. I did the back of envelope calculation just a few minutes ago. That 70 basis points amounts to $5 million. So your plan has gained $5 million just in the year to date because of that extra alpha, which is return above a benchmark. So some of this active management is helping the portfolio. But just looking down the year to date line, you can see US equity up 14%. As I mentioned earlier, global equity, the Vanguard World Fund was up 26%. And again, almost double what US saw. So that exposure, you're about, almost 50-50 there, a little bit more US home bias, but that's really adding a nice return year to date for the portfolio. Fixed income, you can look down the year to date line, all positive numbers across the board. All funds are beating their benchmark. If you look at emerging market debt, up 15% from an absolute basis versus the benchmark of 13%. So contributing to the portfolio nicely from an absolute return. And then on the next slide, you'll see the high yield bond fund up 7%. I think it's up over 8 or 9% through today. So these riskier areas continue to do well with spreads so compressed. Alternatives are up collectively 8%. And then finally, I'll end my comments on the dynamic asset allocation fund. That's up 16% for the year. It is benchmarked to the S&P 500 of 14%. If you recall, that's the fund where we implement some of our short-term points of view. One interesting trade that we had within the fund was gold. We had it as a hedge as we entered, mid-year, just concerns with a lot of uncertainties. We actually sold a few days before it went down, not because we were market timing, but just because we felt it was getting very frothy, excuse me. But that's a trade within that fund, yield curve steepening, some commodity exposure, some, divergence with currencies. So you can see that's paying off nicely with returns above the S&P 500 index, the benchmark. So I will end it there and see if there's any questions.
I think so.
Great.
Thank you.
Thank you very much.
That
So
it?
that's it. No, I would just say that, if we end the year with this kind of performance that's in place right now, it's going to be very beneficial to the plan and our actuarial evaluation report that'll be done next year in Q1 or Q2. So let's be hopeful that it continues on that path. That's all we have.
Yeah, I mean, it's
Yeah,
nice.
who
to
wants?
have
I
some-
know.
It's nice to have some positive news
Yeah.
these days. So thank you.
Yep.
All right. If we're good, I'm gonna make a motion to adjourn the meeting.
Second.
Bob Hart, seconds it.
Thank you.
All right, that's it. Unless I heard somebody trying to say something.
I think we're good.
Okay,
Yeah,
we're good. Okay,
All right.
thanks,
Okay.
everyone.
Thank you.
Thank you.
Thank you. Sorry, I glared at you.